Is the real estate market about to crash? $1 trillion in loans are due this year alone. Why should you be worried? Today, let's chat about something super important: real estate debt. A whopping amount of money is tied up in commercial property loans. And guess what? A massive chunk of those loans will come due in the next few years. We're talking trillions of dollars here, folks. Now, why should we care about this? When these loans come due, those who borrowed them must repay them. And if they can't, well, things start to get sticky. Our buddy Scott Reckler, the CEO of RXR Realty, has been keeping a close eye on this situation. He's calling it a slow-moving train wreck for regional banks. He says that these banks could be in big trouble if we don't act soon, and nobody wants that. Now let's talk numbers. Scott says around $1 trillion of commercial real estate loans are due this year alone. That's a jaw-dropping amount of cash. And here's the kicker: we still need to tackle this problem head-on. We've been ignoring it, hoping it'll magically fix itself. But guess what? That hasn't happened. So why is this problem getting worse? Well, for starters, interest rates are expected to go up. Now, I know what you're thinking. Interest rates? Boring. But bear with me because this is important. When interest rates go up, loans taken out when low rates need to be refinanced at higher rates. And that can be tough for folks already struggling to make ends meet. But that's not all, my friends. Regulators are also putting pressure on banks to reduce their exposure to commercial real estate. Translation? They want banks to stop lending money to office buildings and shopping malls. And if banks are lending less money, that creates another problem: a credit crunch. And let's remember the fundamentals of the real estate market. Things are changing, folks. Office buildings are sitting empty, and people are rethinking where they want to live and work. It's a whole new ballgame out there, and if we don't adapt, we could be in for a bumpy ride. So what's the solution? Scott thinks it's time to face the music and admit that property values have decreased. That means banks must start selling off their distressed assets and taking some losses. It might not be fun, but avoiding a full-blown crisis is necessary. But here's the thing: more action is needed to happen right now. Some big banks are starting to take reserves and sell off assets, but it needs to happen faster. And with transparent pricing in the market, it's easier to know how bad things are. Well, let me tell you why it matters. If the real estate market goes belly up, it could have a ripple effect on the entire economy. People could lose their jobs, businesses could go under, and we could look at another recession. It's not all doom and gloom. Scott says there are still opportunities if you know where to look. Take New York City, for example. Some areas struggle, but others are bouncing back more vital than ever. It's all about finding suitable investments and riding out the storm. So what's the bottom line here? The real estate debt problem is accurate, and it's not going away anytime soon. But if we take action now, we can avoid a major catastrophe. Like, subscribe, and share this video with your friends so they can keep up with the latest news.